I'm Sean Tesoro, president of Salem 5 Wealth Management and Trust, here with the Summer 2024 Economic Outlook. April showers brought May flowers as markets placed greater importance on economic growth and corporate profits than the higher-for-longer interest rate messages from the Federal Reserve. In fact, the S&P 500 ended May above where it ended in March. So as you prepare for your summer vacations, how much should you worry about your stock portfolios? First, based on history, stocks tend to do just fine between Memorial Day and Labor Day, with the S&P 500 rising 1.8% on average between holidays, with gains 70% of the time. Also, consider stocks tend to do better the rest of the year when they rise in May, with an average June to December gain of 5.4%, with positive returns 73% of the time. Seasonality is not particularly worrisome. But investing involves much more than seasonality. Looking at the U.S. economy, slower growth in the first quarter of about 1.3% is expected to be followed by a slight pickup in the second quarter. Consumer spending did slow in April as inflation remains elevated and may slow further now that the excess savings from the pandemic have generally been spent. However, business investment, particularly in artificial intelligence, is helping to pick up the slack. The Fed's preferred inflation measure held steady in April at 2.8% annually, but is likely to come down further as the balance of the year as the economy slows and higher interest rates continue to impact big-ticket purchases. Corporate America has done its part in keeping the stock market well-supported, even underneath elevated valuations. Earnings for S&P 500 companies in aggregate grew about 7% during the first quarter, and guidance was mostly upbeat. Also, some of the major retailers, like Walmart and Target, even announced price cuts, which is helping the fight against inflation. Political uncertainty has ratcheted higher following former President Donald Trump's conviction. The potential market impact of the election is extremely difficult to predict, but we do know the differentiation between Trump and President Biden is widest in foreign policy, immigration, regulation, taxes, and trade. So stocks tied to those issues could see big swings. We also know from history that volatility tends to pick up in the early fall before rallying after the results, and that the economy is usually the deciding factor. So watch inflation, employment, and consumer confidence closely. In terms of allocations, we continue to favor bonds over stocks. Steady economic earnings growth this year has kept the risk-reward trade-off for stocks and bonds fairly well balanced. But moving forward, we believe that bonds hold a slight edge over stocks in terms of risk-adjusted returns, given the current attractive yields in fixed income. Strong year-to-date stock market performance has elevated valuations and may have pulled forward some of the potential gains from pending Federal Reserve rate cuts. That may potentially limit some of the upside in the market as we expect more volatility over the balance of 2024. From all of us at Salem 5 Wealth Management and Trust, we wish you a wonderful and prosperous summer.